Welcome to Apartment Market Dynamics from MPF Research. In the past two episodes, we've looked at revenue change by market over the past 5 years, taking a look at what's happened since right before the Great Recession up until where we are now. We started off looking at the Sexy Six, and in part two, we looked at the best performers of the past 5 years. And today, we wrap up the series by looking at the worst performers over the last 5 years among the nation's 50 biggest markets. And with me to help dive into this stuff, Greg Willett. And Greg, we are defining revenue change as the shift in effective rents for new leases, plus, for the same set of properties, I should point out, plus the change in occupancy over that same time period. So by that measure, who is the nation's worst performer?
Any guesses here?
Well, I have seen the list, but I think pretty much everybody can make a guess on who this is. It's going to be Las Vegas.
It is Las Vegas, and that's no surprise. What might be a surprise, actually, is just the size of the gap between Las Vegas and everywhere else, because it is just huge. Compared to the Metro's mid-2008 performance level, revenues are down 17.5%, with rents off 16% and occupancy down 150 basis points. There are lots of really, really ugly stats that we could throw at you to explain that, but we'll limit the beat down to just one figure. Today, the total employment base is off from the mid-2008 level by just over 100,000 jobs. That's about 11% of the total from pre-recession. So from the huge hole in Las Vegas, let's go to a group of markets where revenues are off slightly compared to their 5-year ago level. And so in the 49th place among the nation's 50 biggest markets would be Atlanta. What we see there, revenues down 1.1%, rents are off 1.6%, but there has been a 50 basis point jump in occupancy. Something that we always talk about when we discuss Atlanta is that the overall stats actually don't tell you too much about an individual property or a portfolio that would be heavy on Atlanta, and that's because the differences in neighborhood performance are so extreme here. And you actually have some spots where revenue growth over the past 5 years would be pretty solid. Probably nobody's hit a home run in Atlanta, but you have some pretty solid numbers in select spots. And then in others, well, it's like you're in Vegas. I mean, they are really bad numbers.
So like you said, Vegas is in its own category, but we do have several markets clustered right around Atlanta's number of revenue losses of about 1% over the past 5 years. And so the next two on the list are two on opposite coasts, Sacramento and Virginia Beach. For Sacramento, the exact figure is negative 0.9%, reflecting rent losses of 1.5%, but occupancy is up 60 basis points. In Virginia Beach, the overall revenue change is at negative 0.8%. coming from rent growth of 1%, but occupancy is down 180 basis points. Now, Sacramento's story is a lot like many of these other housing bust markets. A lot of them are right around there among the bottom performers. The housing bust translated to a deep hit in the local economy and certainly led to a slow recovery as well. Virginia Beach is a more interesting story. It's a little bit different from what we see anywhere else. The recession here really wasn't that bad at all, but due to some very unique factors in the local economy, it's had some trouble getting any momentum whatsoever. And so it's had a hard time basically moving the dial from zero. Now, we have seen a little bit of momentum over the past couple of quarters, but certainly in the big picture, the story is that Virginia Beach, Norfolk, is one of the most underperforming markets in the country.
Two more markets for you and two more housing bust stories here. Next up on the list are Riverside and Phoenix. In Riverside, the change over the past 5 years has been revenues off 0.5%. The components are rent change at minus 2%, but occupancy growth of 150 basis points. For Phoenix, the revenue loss is 0.3%. Rents are off 3.3%, but occupancy is up 300 basis points. And what I'd say is really interesting to focus in on these two is the fact that the occupancy numbers are coming up. And particularly in Phoenix, the occupancy numbers are coming up. As you look at the 50 biggest markets across the country and just change in occupancy over the past 5 years, the only spots that have done better than Phoenix are three places in Florida: Jacksonville, Orlando, West Palm Beach. Certainly that tells us something about how far these fell during the recession, but it also tells us something about the ability of the economies to come back. And so these are metros that are having good growth now, and occupancy is headed up there. So what we see moving ahead in Phoenix, there's actually probably going to be some pretty good momentum, and particularly in middle market product, where occupancy has gotten back to close to full rates, and rent growth is starting to kick back in. Maybe this one's going to be a little bit tougher at the very top end of the market. In those properties, you're vulnerable to losing residents to single-family home purchase, and also we have to say new construction has started to come back in Phoenix at maybe a little bit more aggressive level than you would have thought.
Then moving on down the list, New Orleans, 5-year revenue change just above zero, actually 0.6%, with rents down 1% and occupancy up 160 basis points. Obviously, the challenges here go way beyond what happened in the recession. This is a market still rebuilding from what occurred from Hurricane Katrina, and New Orleans remains largely dependent on adding lower-paying jobs related to the tourism industry for getting any economic growth whatsoever, and that's just not going to be enough to build some vibrant economic growth for the economy overall. And then jumping from the Gulf Coast to the West Coast, next on the list of comparatively weak performers over the past 5 years are Orange County and Los Angeles. Orange County revenues are up 0.9% over the past 5 years, rents up 1%, but occupancy off by 10 basis points. And for LA, the revenue growth figure is at 1.6%, rents at roughly the break-even point, actually up 0.1%, and occupancy up 1.5%. And we talked about Los Angeles in the previous video on the Sexy Six markets, and we pointed out that the metro's job base remains way, way below where it was 5 years ago. And for Orange County, it's basically the same story. It's important to note, though, that for both of these two, when we look at the 5-year rankings, it really reflects just how hard hit these two were during the recession. And so momentum was slow to return, but it is coming back to a significant degree. And these, among all the markets that we discussed, these are two that actually have a pretty good chance of really moving up on the rankings going forward. And so there's pretty good potential in those two spots.
All right, Jay, one more market for you on our list of bottom 10 performers across the country over the past 5 years, and we wrap it up with Memphis. In this market, the revenue growth number is 3% even. Rents are up 3.9%, while occupancy is off 90 basis points. Something that we talked about when discussing in Atlanta, there's a lot of variation by submarket in Atlanta, and that's true in Memphis as well. You actually have two spots where the performance has been pretty good. That would be the upscale suburban area of Cordova, Germantown, Collierville. And then downtown has also done pretty well in Memphis as well. But the rest of the metro, not so good.
Yeah.
Generously not so good.
So, Greg, we've covered a lot of info in this 3-part series on revenue change over the past 5 years. Any key points we want to miss? Any final points we want to make?
But something that occurred to me as we were going through this list is we didn't really talk about the Midwest too much. Columbus was there on the leaderboard for the top performers, but otherwise we didn't mention the Midwest. And so that means they're all pretty much middle of the pack. And that's not really a bad place to be whenever the overall results for the country as a whole are in good shape.
And there you have it. And that wraps up our 3-part series on revenue change by market over the past 5 years. So for Greg Willett, thank you for watching Apart Market Dynamics from MPF Research.
Want more? Go deeper with MPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, MPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.